Recent data has revealed that Africa's tech ecosystem is regaining its footing, with startups now seeing a significant rebound in funding activity just this past month. Now, a database that tracks monthly startup funding called Africa the Big Deal says that startups announced total funding of about $550 million in July, which is the highest amount raised in a single month in over 2 years. About 61 African startups announced at least $100,000 in funding, which is a significant jump compared to the first half of the year, when we saw that number hover at around 40 companies or fewer, typically. Now, of the 61 startups spread across 15 nations, about 41 are located in the big four markets. That's Nigeria, Egypt, South Africa, and Kenya. However, the report also noted that 89% of the $550 million raised came from debt. That is a fact that experts say signals a major consequential shift in how startups are financed on the continent. Well, let's find out more about this shift. We're now joined by Seyi Ebenezer. He's the CEO of Nigerian-based fintech Payaza. Great to have you on the show with us again, Seyi. Now, of course, let's start off with the key point this report makes, which is the fact that 89% of the $550 million we saw raised so far in July came from debt. Why exactly is this being considered a major shift in how startups are financed in Africa?
Thank you so much, Uche. It's very, very major and highly consequential shift. You know, historically, the narrative around African fintech startup has exclusively been around VC funding and equity. But this is an exceptional growth, that the 89% cut across almost about $489 million. So which talks to the increase and then the growth within the space. And we are looking at debt, a single debt in a particular month. That's very, very dominant, and it's a huge paradigm shift. So this virtually signifies that the ecosystem is growing, and then people are doing business. The business model within the tech space is quite different. The business model is being appreciated. People are more focusing on the EBITDA. You're looking at the profitability of each and every business within the ecosystem. So that's the reason why you're seeing the shift. And then I think we expect more of this within the ecosystem.
Right. And it is interesting because when we talk about African startups, we usually talk about VC funding, for example. But let's talk about how Payaza is going about it. You are currently the only African startup that is raising local currency debt via commercial paper. In fact, you recently secured another 20 billion, or rather approval from the SEC to raise another 20 billion naira. What are the reasons that you are not as cautious about debt as others seem to be in the industry?
Okay, from the get-go, what we set up to do at Payaza is just to create an oasis of a world-class payment institution that can function anywhere in the world. And then going by this vision, we need to start doing things differently. So that's one of the reasons why our focus is shifted away from VC. And that's why we focus on debt. Essentially, if you look at debt creates one thing, which is discipline. And then before you can have access to debt, like what we've done our Series 1, we've done our Series 2, we did the repayment, which was on live on FMDQ. So looking at this particular from, it tends to have high impact on your corporate governance, how you run the business, and then more importantly, I think within the ecosystem, that discipline is the hallmark is the hallmark that you need to set the standard for a business who is going to go global and then do things in a different way. So that's one reason why we're focusing in that space. We keep raising because our business model supports it and then gives us the structure that will push the business ahead of each and every goal and the vision that we set for the business.
Now, I do find it interesting, Seyi, that we say this is a significant shift, because if I look closely at the report, 89% of those funds raised were from basically two major companies in July. So In light of that, not very many African startups seem to be flooding the space when we talk about raising funds through debt. What are the key factors that you think are making founders still sort of skeptical about debt as a fundraising tool?
Okay, I think debt is categorized in different folds. For instance, if you go to a proper commercial bank, they tell you that there are 5 C's to credit, which talks about the character, capacity, collateral, condition, and those are the major 5 C's that is being checked. So, one of the major reasons why founders are skeptical around it is all of the requirements. So, but one of the things that I think we need to start doing differently within the ecosystem is to look at all the requirements, what it takes to access this debt, and then begin to build our business model towards that process. So that will really, really help a lot of founders to play within that space. Case in point, we did our rating, which I spoke about. If you're looking at rating, so your corporate governance is more important within that space. And then if you're going to go into credit, if you're going to go into debt, the importance of how you're going to manage your cost is very, very critical. So you're going to look at your cost at every level, your cost of operation, cost of doing business, cost of onboarding, so the cost is very, very important. So those are the discipline that needs to go into this play. So I think that's one of the reasons. But within the ecosystem, we need to start encouraging ourselves to play more in this market. And you could see I think Nigerian capital markets is currently growing at about 61%. We've gone back to the years of 2005. The market is doing very well. The all share index going up, market capitalization going up. So we need a lot of participants within this space.
And that's my next question, because when we look at the different levels of accessing funding through debt, what is your take on how mature Nigeria's market is, Kenya's market is, South Africa's market is? What's your experience and your take on Africa's maturity when it comes to local currency markets, credit ratings, and also regulation?
Yeah, I think the African market, we begin to appreciate each other, and I think Nigeria is doing very, very well. If you could see, NGX is doing awesome. You see banks like GT Bank crossing or share price in excess of 100 naira. See market like Ghana is booming as well. Have one of the strongest currency in the last 6 months. I think that's the most appreciated currency. Looking at South Africa as well, all increase on all the sides. So one of the things we need to just appreciate within the system is that the market is growing generally in Africa. We begin to appreciate ourselves. I think African businesses are beginning to lend to African business. We've experienced that in the market that we came out. Institutional investors have approached us. We've managed their fund in a different way, and then we've been able to repay. And then we've seen a lot of integrity plays within this space. So I think African debt ecosystem is growing, and then I think it became it's more of future oriented, and then we're going to see a lot of structures come into play within the system.